honestly, I think especially for people doing a lot of deal flow, that would be a turnoff to see something that is not a safe at this point, just because people who have done it many times could almost recite how a safe term looks. So a safe will typically have several things. It will have a valuation cap, the purchase amount, obviously, the amount that's being invested, and then a discount rate, right? Or a discount. Going back, a valuation cap is an amount of money, and I'm going to explain this in a, again, overly simplified way, but I think we'll get the point across. A valuation cap is an amount of, it's a valuation of the company that you are using to as the ratio of equity that will be given relative to the purchase amount. That sounds confusing. Let me put that through an example. So this is a $10 million valuation cap, right? And let's say the purchase amount, just for the sake of rounder numbers, is 100,000. That is basically saying that for $100,000, you would receive 1% of a company at a $10 million valuation, right? That is not entirely true. When I say I'm oversimplifying, I am oversimplifying because there's common shares, there's preferred shares. Typically, these are preferred shares. There are certain things that will dilute equity over time. But all said and done, for the sake of simplicity, you're basically saying that I'm committing to providing this capital in exchange for a set percent of the company's equity, right? And then whatever, so once later down the line, when the company has subtraction, something called a 409A will take place, which is an independent third-party valuation that's incredibly thorough. And upon a point like that, suddenly the promise of equity turns into true equity at the ratio that you agreed upon in the safe, regardless of the value of the company. For instance, if you agree to 1% of the company for $100,000, and then the company is worth $30 million, suddenly that's essentially a 3x, right? And so on and so forth. That's the general idea of how that works. And we'll go into why that's actually meaningful in a moment. A discount is essentially an insurance policy against lukewarm growth and development. And so I think a way to look at that is basically to say, if the company's valuation at the time of a 409A is at or below that 10 million valuation cap, you're still getting a piece of ownership that is discounted by 15%. So basically you're getting it under the valuation cap that you agreed upon, right? So what does it all mean? Like, where is this valuation cap coming from, right? Now, this is where I think things begun. This is where the value of really understanding this stuff comes in, because the literacy around this is going to make or break your ability to turn this